Hi, today I'm going to talk about probably the most powerful chart pattern in the market. It's called the bull flag pattern or high tight flag pattern, and it often leads to moves of 30% to 100% or more within several weeks to a few months um, out of this pattern. And I'm Brian Neal, founder of Tradetobefree.com and InvestBeFree.com, and I've been trading this pattern now for more than 10 years and have had a lot of success with this pattern. And I'm going to show you what it is, how to trade it, and how you can find more of these patterns in your own trading. And before I begin, I just want to point out that I've been doing this for more than 10 years, and I've been the author of the weekly alert and daily alert on TradingBeFree.com since 2004. I founded that site and also InvestBeFree.com. We're a member of the Better Business Bureau and have been since 2006. We have the highest rating with them, an A+ rating for a few years now, and I just want to point that out before I begin. Okay, like I said, the bull flag pattern is considered by many technicians to be the strongest chart pattern, and it leads to these big moves of 30% to 100% or more. You often see these in late fall and winter, but you can find them throughout the year. And it's actually a special form of a flag pattern, and it shouldn't be confused with the flag pattern. It's the bull flag pattern is a very extreme case of the flag pattern, and tends to lead to much bigger gains. Okay, so what is it? What creates the flag pattern? Well, it looks like a flag on the chart with a flagpole and either a pennant or a flag off to the right. Okay, and it occurs when you see a 90% move or better move within a couple months. Okay, then the price moves sideways, it consolidates and forms a flag portion of the pattern. Now this flag can be either rectangular shaped or it can be a pennant. Okay, and the pattern is sometimes referred to as a high type flag. Okay, now here's an example from a recent newsletter on our site. And this is Frontline, which was featured to subscribers back in early January of 2015. And as you can see on the chart, you have the strong move from the lows here in late November to the highs in December. Okay, and that's the pole of the flag. All right, and then you have the consolidation from left to right. That forms a flag portion of the pattern. In this case, it's more of a pennant. Now, in this case, the flag is not really well formed. It's kind of a loose pattern. You usually want to see this consolidation much more tight, what we would call tight, which means less volatility. Now you can see before it breaks out, it does tighten up here in late December, early January before it breaks out. But you can see the strong volume leading into the pattern and the very strong volume on the breakout here when I featured it to my customers. And that's a good sign too. You want to see the high volume taking the stock out of the pattern. So that's a breakout when the price moves above the flag portion of the pattern. And we can see that if we change the time frame on this chart here, we can see that back in January when this stock broke out, it was followed up with a very strong move higher within a week or so. So you can see that stock moved over 50% from where we featured it within about a week. So that was a huge move. And you can see from there it sold off and it consolidated back to the support area in the flag. Now sometimes these flag patterns will take off and they will continue to go higher over time, but in this case it turned over within a week or two. And you'll find that that's often the case with these lower price stocks. Okay, so the entry point again is to move above the downtrend in the flag or above the top of the flagpole. In this case, it was above the top of the flag. But if you see a very well formed downtrend within the flag, you can also get a good entry point as the downtrend breaks. Okay, now the stop loss is generally put beneath the support in the flag portion of the pattern. Okay, and you definitely want to put a stop loss in with these trades. A target sell price with this trade is usually about half the initial move into the flag. measured from the lows before the flag to the top of the flag, and then project that move from the bottom of the flag or the lows in the flag. Okay, so you want the second move in the ABC up pattern to be half the initial move. Okay, so here's some tips for trading this pattern, because there are a lot of nuances that are very valuable to know. I'm going to share some of those tips here in today's presentation with the time I have. You want to watch out for a large gap leading into the flag. Okay, now this often occurs when you have a buyout offer of a stock. So if you have a stock selling for $50 and a buyout offer comes in for $80, the stock will gap higher to 80 and then trade sideways in a tight range around the $80 area. Okay, and that's because of the buyout, and there's really no more upside potential in that stock given the company is being bought out at that price. So that price will be fairly fixed for the next few months, probably until this transaction is completed. So you want to watch out for that. There's no reason to trade a flag pattern in those situations. You also want to be careful of penny stocks because they're more prone to turn over quickly. A lot of penny stocks are promoted. You'll see a circular in the mail or an email touting the stock, and the stock will jump up in price soon after, but then it'll generally sell off very soon after that. And so you want to normally avoid penny stocks. Now, in the case of Frontline, we saw that the fundamentals were improving very quickly because the estimates were rising. The price of oil is going down, and so more oil is going to be shipped across the globe, and they were standing to benefit from that. So that was a case where a penny stock was still a good opportunity. And we're very careful, very selective when it comes to penny stocks, and we'll only feature the very best ones and trade the very best ones breaking out of this pattern. But you'll also find this pattern in higher price stocks too, above $5, and those tend to be higher quality. Now you want to see low volatility in the flag portion of the pattern. In general, that's better. In the case of Frontline, it was more loose, but you could tell that the volatility was shrinking as it neared the breakout point, which is a good sign. And you also want to see strong undervaluation and or rapidly improving fundamentals with the pattern. You want to see the fundamentals supporting the price move. Oftentimes in penny stocks, you won't see any real near-term increase or improvement in the fundamentals supporting that big price, and that's when you want to be careful. Okay, so here's some more tips. You definitely want to put a stop-loss order in with these trading setups because they can move quickly in either direction, and oftentimes they work out really well, but sometimes they don't. So if they move in the other direction, you want to get out quickly, and you want to have that stop-loss order in there. They don't work or tend not to work in a market downtrend or after a bearish market signal. If you're in a bear market, you want to avoid this pattern. They tend to break out and then turn over quickly. You also want to look for overhead resistance. The best patterns are one where there's no overhead resistance. In other words, if you go back a year, 2 years, 5 years, there's no time period where the stock was trading at higher price to where it's breaking out at. Okay, so that's called overhead price resistance. We want to avoid situations where there's a lot of overhead resistance, but not necessarily exclude the opportunity. I mean, if the fundamentals are still very strong and there's other significant factors supporting the price move, you still want to look into a potential trade on that stock. And again, we avoid the vast majority of penny stocks breaking out of this pattern and only feature the ones to customers that have the very best formations and have the fundamentals that can support the higher move. Okay, so we find these patterns a few times throughout the year in our own trading and for subscribers at Tradetobefree.com. We find them only on elite growth stocks or stocks with rising estimates with a track record of beating those estimates, preferably both. Okay, and When you come to our site, you can get a free trial of that newsletter where we'll find these patterns for you before they break out, before it's too late. And there's a link below this video where you can just click that link and just enter your email. There's no credit card required at this point as I record this to take that free trial, so take advantage of that. It's free for 3 weeks. There's also a special offer below the link, so if you've taken our free trial, you can get a special deal to subscribe if you do that soon. And you also want to check out our book, if you haven't already, on our site, where we explain our swing trade system on elite growth stocks and stocks with rapidly improving fundamentals in terms of estimate increases and beating those estimates. And in that book, you also learn how we knew to go bearish back in early August of this year and before all the major sell-offs over the past 10 years in the market. So you want to check that out too. So thanks so much for listening. Again, click the link below for the special deal and the free trial.